anywhere, anywhere with you. Cause you fill my mind, oh, you fill my mind. We could build a dream, start up something new. And the world is on your shoulders and you feel like falling over. Just let me in your head so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing?
Hello, everybody. Welcome to VC Masters, only on the Pod TV network. I'm Nick Palavita. I'll be your host for today's presentation, but actually the person who's going to be doing a lot of the legwork is none other than Salman Alzar, who's a professor at Duke University, and also he heads the Azimuth Fund, which he's going to give us the latest and breaking news on the area of venture capital. And we want to thank our people in LinkedIn, Facebook, Twitter, Twitch, YouTube, and of course the TV viewers on Roku and Amazon for tuning in to VC Masters. So there's a lot going on in the venture capital world now. I hear rumors that the IPO market is starting to move again after being frozen, but maybe you're more updated than I am. I also do know in my industry, private equity has been moving in and purchasing insurance companies and independent marketing organizations. They're heavily involved in the financial services industry. So give us up to date what's going on in the VC world. Dr.
It's definitely exciting times. We had a company that was in SEC review, and then the government shut down and everything was paused. So everything was on a timeout mode. And now we are kind of like waiting for SEC to get to us. They probably have 20 other companies that they're looking at the same time. So hopefully, we will have an IPO later this year. Well, that's kind of very high hopes, though, but more expected January. So what was supposed to happen in December is now pushed to January, which in the big scope of things is not such a big deal. But the IPOs this year have been steady. Some of them have been a little bit rocky, but most of the ones that we have been involved in have been steady. We don't chase hype. We don't chase AI. We feel AI, for example, is overvalued right now. There's no point kind of chasing it. We are looking for generally solid businesses that can be helped with technology, and technology would include AI, and those have been doing generally well.
Mm-hmm. Yeah, and the thing is, the AI hype. One of our producers on one of our financial shows was saying that something like 95% of AI companies aren't making a profit. Is AI more hype than real? I mean, for me as an investor, I don't go to AI because I don't like to follow the crowd. But is that AI really not producing, or is it only producing for certain people, or is it hype?
Well, I won't put an adjective on it. I look at mostly on the fact side. So 95% is probably accurate. It may be even more than that. So all these companies that are focused on AI right now are in a FOMO mode, fear of missing out. And they are investing billions of dollars in trying to get to the place where nobody else can climb. And this reminds me of the .com era, where if you take the top companies and you combine their projected market share, it came up with something like 100,000%. And that was obviously much higher than 100% that it needs to add up to. In the end, there are going to be a few winners, but there are going to be lots of casualties along the way, which is, for that reason, we are out, as they would say in Shark Tank.
Right.
And profit is not even an objective in that right now. It is capturing the market share. And once again, .com era, we used to say, this was more of a joke, that, we'll sell something for 85 cents that would cost us $1 to make, but we will make a profit on the volume. So if you really think about that, the math of that doesn't add up, because you just end up losing more and more money. So so that's where basically we are as far as AI and technology and generally things are concerned. I think the hype would be an accurate word. I would rather say that they are overvalued right now. In fact, I was just looking at this report that you can see the graph going up, that the early stage valuations are going up on seed stage companies. And then the flip side of it is that if you look at the green line at the bottom, there are only 48% companies that are getting funded for the next level, which is down from the previous. The number of companies that are getting funded is down 48% from previous year. So if you really put the two and two together, and you are an early stage investor in AI or really any company, chances are that you will be paying a higher price than you would have paid a couple of years ago, and you have lower probability of success. And
let's talk about venture capital versus the S&P 500 and who wins. Because the thing is, when it comes to the S&P 500, the word on the street is, oh, well, you should be in the S&P 500. And we have one show that one of our persons who's a doctor goes, well, everybody should be in the S&P 500, and then half cash, half S&P 500, and keep balancing the account S&P 500. But is that really true? Does the S&P 500 beat venture capital all the time, or is there opportunities in the venture capital market? Who wins this battle? What's your thought?
It's a really very interesting mathematical challenge to kind of solve, to answer that question, because it's a multidimensional question. So the first thing that I would tell you is that most of the venture capitalists do not return a profit to their investors. Most of them lose money. And the reason they lose money is that everybody and their sibling thinks that they can become a VC. So there are lots of one and done in this game, very much like the restaurant industry is for the retail, is that it's the easiest thing to do to start a restaurant. Similarly, VC, starting a VC is much easier than starting a company. So people say, okay, I'm just going to make money off other people. But what happens, in reality is completely different. Most of these VCs lose money or barely break even and don't even meet their expenses. The top 20% are the ones that make most of the money. Mm-hmm. And when you take the average, blended average, the top 20% make so much money that they make up for the bottom 80% or so. And the 80-20 kind of like is a variable, not a constant here. So if you take an amateur investor on the street, it is better for them to invest in S&P because they have a higher probability of making money. But if you take a more informed investor who checks out the VC before putting money in, they would make more money in VC by far compared to S&P 500. There may be times of liquidity crunch where, like the last few years, companies have been delayed going IPO, and that is going to push their liquidity or getting cash back. But overall, VCs overall and top VCs beat S&P 500 over a period of time.
Let's talk a little bit about the Research Triangle Park, which is quite an interesting thing. It's been around a long time, where Duke University, North Carolina State, North Carolina it's close to all three universities to provide intellectual firepower in terms of startups and venture capitals. How do you see that happening? Because the data I get shows that the state of North Carolina has 0.37% of venture capital money, where California has 59% of all venture capital money. So how does the South rise again, Dr. Azar, when the thing is the capital markets of California, they have about 60%. And when you're looking at the Research Triangle Park, you may have an equivalent intellectual firepower, but in terms of capital, you're at 0.37. So how are you going to balance that particular equation?
Do you want me to answer that question honestly, or do you want me to give you
No, I want you to answer it honestly, because the thing is, it's always boggled my mind living in North Carolina. I was going, and I do most of my business in California because I do everything on the internet. So even though I'm headquartered in Salt Lake, everything's in California, but also it's because the demographics of California, 60% the demographics of North Carolina, 0.37, and I have to admit we do very little business in North Carolina because of the lack of, frankly, the lack of capital. It's like saying I'm going to go to, Gabon, Africa, and raise tons of money. It just ain't happening. So how do you balance it? Yet when you look at the intellectual firepower, you got Duke University, a top 10 school in the United States. You have North Carolina State, one of the top 100s, and North Carolina, one of the top 30. You have a lot of intellectual firepower, but you don't have the equivalent capital. So I would like to hear your thoughts on that.
Yeah, so I'm kind of deeply connected to this issue because when, so the way I came to Duke is very interesting. I never really applied for a job or didn't want to really envision moving. I was in San Jose, California, in the middle of Silicon Valley, really had no intentions of move. And I was on college tours with my oldest son. And part of my college tour was our college tours was Duke University, where my job really was to go with him and introduce him to my former professors to help him get into Duke. It turned out that they were more interested in talking to me, partly because there's kind of like a firewall between admissions office and professors, but partly more because of my VC background. And at that time, Duke was starting this Duke Innovation and Entrepreneurship Initiative. And part of the interview, if you want to call it, it was very informal conversation. Somebody very high up at Duke asked me, "We want to create another Silicon Valley here. Can you help us do that?" And I told him, "Nope, it cannot be done." I was a little bit more polite and less curt about that. And but within itself, North Carolina and RTP area can do something, but it can never, in my opinion, get to the point where it can compete with Silicon Valley. Silicon Valley's main advantage is that it is a phrase that we use there, is that people don't pee in their own pond. Because everybody knows each other, nobody is going to throw people under the bus and cheat them out of money and so on and so forth, because then they will be banished from the community. And that is not something that is happening here. The investor community is not very cooperative. It is very competitive. On top of that, there are little players that would invest like $1 million in a company and they'll walk around like they own the town. And in Silicon Valley, it's quite the opposite. The people that are really making the biggest impact are generally the one that, you don't even know that they are VCs. You would hear Peter Thiel and Joey Lonsdale and people like that. But that's a minority among the people. Most of these VCs, you don't even know that they are VCs. I remember it's like Sixth Sense, they don't, they walk around just like regular people, where the Sixth Sense that said like they're dead. I see dead people. They just don't know even they're dead. They walk around like regular people. So VCs just walk around like regular people. It's a cooperative environment. Here, I just didn't feel that cooperation. I felt that, it was kind of like the phrase, the stakes are so low that the competition is so high for them.
Mm-hmm. Yeah, different environment. Now, tell us a little about the Azimuth Opportunity Fund. The financial services industry is obviously interested in venture capital because it's in part of their asset allocation model. Tell us a little bit about the Azimuth Opportunity Fund. What does it do? What's it structured?
So we exploit the fact that we are in a liquidity crunch right now. Specifically, about 300 to 400 companies are in the pipeline to go public, but they are delays and they cannot go public all at the same time. And what now has happened is that a lot of early stage investors want their money back. A lot of these investors are funds that are in their last year or so, where the people that invested in these funds for life event or something like that would want money back. It may be like, hey, I made a bad real estate investment, and I want, and I'm kind of I just need cash. Or it may be like the person who made most of the money for a family investment office has retired or passed away. And now the younger people want to buy Lamborghinis and mansions. So there's a lot of pressure among the investors to get their money back, whereas there is delay in the liquidity in the IPO. And you mentioned something earlier that private equity is gobbling up some of these companies, and that's going on as well. That private equity is basically seeing that they can get quite a good value for money. So we generally don't invest in a company unless we get 40 to 50% discount on its fair market value.
Mm-hmm. Okay. So then the thing is, then the investor has an opportunity to do well, assuming that, of course, the company goes public and does well. When you're looking for a company that's in that position, do you look exclusively in North Carolina, or do you look around the United States to find opportunities for companies that are online to go public, late stage, I would say?
So we look all over the country. So so company has to be registered in US and plan to go public in US in order for us to invest in it. They can be doing business anywhere. So for example, we have a company, Coros, that does a lot of business in Europe. We have a company, Quesky, that does most of its business in Mexico. But as long as they are planning to go, they are usually a Delaware or Nevada C Corp, and they're planning to go public in US, they are fair game for us. And our initial deal flow, in fact, all our deal flow so far has been from companies that we have already invested in. So we have investor information rights and sometimes board information rights that gives us the information of which companies we want to double down on. So whereas there are other VCs that are focusing on their losers and trying to keep them alive, we are actually focusing on our winners and trying to make more money. And I feel that our strategy is superior, because sometimes the best thing you can do for a company is to let it die a quick, painless death. And just focus on your winners, because there's a power curve here, right? When you invest money, let's say you invest $50,000 in a company and you lose all your money. But if you invest $50,000 in a company and it does well, you can make millions from that. Mm-hmm. In fact, the best investment I made is 171x return. So for every dollar, I got $171 back, which is huge. Mm-hmm. Now, Azimuth is not going to give me that. Azimuth is more about getting 2 to 5 times my money back in 1 to 4 years. And the way that formula works is that we get an initial 45% discount, which is, on the average, so that almost doubles our money. So next morning, we wake up and we have almost doubled our money. And then these companies that we are investing in are growing at about 30 to 50% a year. So that helps us go more than double our money if it's a 1-year play. If it is a 2-year play, then the 30 to 50% growth comes in and we continue growing, and we would go up to, like, our horizon is up to 4 years where we get 5 times the return. And that's really, the highest return that we can expect. If, we are lucky, we may get 7x, 10x, but I doubt that we could get anywhere more than 10x with this strategy. But what we don't do is we don't lose money. Our strategy doesn't lose money. So it is more focused on, from a VC perspective, it is more focused on return of principal or return of investment, as some people call it, as opposed to return on investment. So, right. So we give up some of that. And because the VC market, where it is right now, that is fairly easy for us to have very good protection for downside and still get 2 to 5 times the money back for investors, which, by the way, on the average, that's huge. That it's just like we are consistently hitting singles and doubles. Right. We're not even going for home runs.
Yeah. Okay. This is a compound question, but it's an important question. Okay. How do you find companies to invest in, and how do investors find you to invest in?
So the first part is really easy. So between my partner and myself, we have invested in over 300 companies, and we have information on these companies. We know where we want to double down, and that's where we find most of our companies. Occasionally, we would have somebody in our network who we trust say, "Hey, I am involved in this company. This is a great company, but there's this investor of co-investor who wants to get out. And by the way, that person is a jerk, and we don't want to replace that with another jerk. Can you look at this portfolio and buy it? And we have bought things like that. So we in fact today somebody was trying to sell me a secondary market, and I asked for data, financial data, operational data, and so on, and they said, oh, we can't provide that because of blah blah blah. And I said, well, I mean, we are professional investors. This is not like we are going on Hive or Forge Global where you can trade anything without any information. We make informed decisions. So we make informed decisions on that front, and we are putting our own money at risk, and on top of that, we are putting our friends and family's money, and so on. So that's the answer to the first question. The second question is that most of our investors these days are coming from people who say, "Hey, I know you're doing this. I want to learn more." So it becomes, a more of an educational thing, because it's a little bit harder for a general person to understand how VC works and how VC makes money. VC being venture capital. So they actually reach out, and some of existing investors introduce their friends and family, and so it's more organic growth that we are experiencing right now. And it's really, really nice because I don't have to work so hard. Things weren't quite this way about a year or two ago, because this is a new strategy for us, both for David, my partner, and I. We are early stage investors traditionally, and I showed you the data on early stage is that you're paying more these days for lower probability of success, and for that reason we don't want to do that. So it used to be for us to establish ourselves in a different market. It was, it's like Michael Jordan, right? Great at basketball, but all of a sudden, let's say NBA shuts down, and now he has to play baseball. And people don't know that he is a good baseball player as well. And we had to convince people that we can play baseball too. And actually, we can play baseball better than Michael Jordan could play baseball. Well, we can do this better than secondary markets, and 2 to 5x return better than Michael Jordan could do baseball. And once people got convinced, it's mostly through referral. So, if you are an investor, you would refer other people. If you're curious about how venture capital work, we will educate you. And then, there's like no selling in this. It's just like educational thing.
Mm-hmm. Yeah. And what about family offices? Do you work with family offices? Because there's a big trend in financial services where people are collaborating, and they're putting together family offices where there's an attorney, a CPA, a financial person, and they're doing it for high net worth. Obviously, they have their family offices, but also they're doing it for the mid-market. What's your experience with working with family offices?
We love working with family offices because there is a personal touch to what they are doing, and they really try to understand what we are doing and get into it. The whole concept that we are exploiting is something that's 2 to 3 years old. And family offices in general come in with like, tell us what's going on, tell us how this works. And they're a lot easier than like a fresh MBA who has never heard of this concept and say, okay, this concept is fairly new. There is no like track record of people buying secondary shares, getting 2 to 5x return. We are effectively in growth capital, but we do not give money to the company. We buy shares from existing investors. And that's what's sometimes so hard for people to understand, because we operate, our financial picture is more like growth capital, that we will ensure that we are not going to lose money, and we will make, a little bit of money. So family offices are great for that, because they are generally curious, and they are humble, and they want to learn where their money is going. And how it's kind of going to impact people and so on.
Mm-hmm. Okay. And what about accredited investors? Are you strictly having to work with accredited investors, or can you even work with unaccredited investors?
We work with accredited investors only. So we can't work with unaccredited investor because of the regulations under which we operate. It would make they're just completely different set of regulations. An accredited investor is basically somebody who makes over $200,000 a year as a single, or a married couple that makes over $300,000 a year, or has a net worth of or personally or as a family has a net worth of $1 million or more, not excluding the home.
Right.
And generally, a lot of tech workers or professionals, actually, I shouldn't just say tech workers, a lot of professionals that have a few years of experience are accredited without them knowing that they're accredited based on income. So I get a lot of incoming interest from my former students who have been out in the industry for a few years. Several of them are investors, and then they refer other groups of people. And it actually started with my own son, whose company went public, or the company he had pre-IPO shares went public, and he had all this money, and all of a sudden he was accredited. But then he said, oh, a lot of my friends meet the accredited requirement based on their income. So we originally had a $250,000 minimum, which is kind of standard for VCs. We lowered that to $50,000 so that these people could participate. And now they give us like, $50,000, $25,000, $15,000 every quarter. So it's like an annuity kind of investment for them. And these people would not have an opportunity to get into venture capital and make the kind of returns that VC does give you back if it weren't for us kind of experimenting with them. Now, a lot of VCs don't want to experiment with these people because that $50,000 investor is usually the first one that calls you and says, SEC is shut down. How does it impact you? When is it reopening? And like, I don't know when it's reopening, but because we have like a group of people that already have that trust, we haven't received a single call saying, hey, you're working on Chia, which is going to go IPO soon. What is the impact of SEC shutting down on Chia's IPO?
Right. And how does 2026 look to you? I know we're almost finished with 2025. It looks like we have not too much time left. But how is the 2026 shaping up, and what is your projections for the coming year? 2026.
Yeah, I'm looking forward to 2026. I think the IPO market it has been going in bursts and opening up, and I'm expecting 2026 would be better. I'm really looking forward to 2027 even more than that, because a lot of companies that we are invested in are maturing, and 2027 is when a lot of them are going to give us a return on our investment. And the biggest issue right now for startups is inflation, because startups operate fundamentally on the concept that you put in money now to get money back later, and if the later money is inflation really kind of beats down on later money, it makes the whole value proposition of startups a little bit harder. So 2026, I'm optimistic it would be better than 2025, kind of like similar to the late half of 2025 without the SEC shutdown, hopefully. And 2027 would even be better for exits.
Mm-hmm. Yeah. And the moats around the company, I think this is a very important concept that you brought out in a previous show, and I can't forget it, because the thing is, I think it's a real powerful concept. Tell us about companies and the people that are listening that have companies, about building the moat around your company and the importance of that.
So we like to invest in unicorns, companies that are going to give us outsized return. And the question then is, if this company is wildly successful, what happens? And if it is wildly successful and somebody comes and eats their lunch, then it's not a very good investment. So it has to have a moat, or it needs to be able to defend its position. So think about this as, to use a sports analogy, did you win a title? Like, Oklahoma City Thunder won an NBA title. Now it is time for them to defend that title. Everybody is coming for them. Every game that they play, people want to say, I beat the champions from last year. It is very similar. In fact, it's even more competitive when it comes to a successful company. They're going to have a target on their back. Other people are going to copy what they're doing, and they need to be able to protect that. And they can protect that by having that moat. That moat can be intellectual properties, patents, trade secrets. It can be the number of consumers or customers they have. So for example, Facebook has a big moat because of the number of people on it. And same thing with LinkedIn. So if you wanted to start another LinkedIn or Facebook, you will have trouble getting, you can do the UI, you can do all that, but you will have trouble getting your friends on it.
Yeah, absolutely agree. And I think it's an important concept that all the viewers should know about, especially the business owners who are looking at this. Make sure you build your moat, and protect your capital, and protect your castle along with your capital. And we do want to thank Dr. Salman Azar, professor at Duke University, one of the founders of the Azimuth Opportunity Fund, for this very enlightening show, and our viewers, of course, in the United States and around the world on the Pod TV network. And we'll see you next week. Take care. Bye-bye.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head so I can be there for you.